This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Serezna.
MacroVoices episode 431 was produced on June 6, 2024. I'm Eric Townsend. ECRI co-founder Lakshman Achuthan returns as this week's feature interview guest. We'll discuss the growth and inflation cycles, why inflation is likely to remain sticky, precious metals, energy prices, and much more.
And I'm Patrick Serezna with the Macro Scoreboard week over week as of the close of Wednesday, June 6, 2024. The S&P 500 June futures were up 155 basis points, trading at 53.66. The S&P 500 closed at an all-time new high. We'll take a closer look at that chart and the key technical levels to watch in the post-game segment. The U.S. dollar index down 76 basis points to 104.30. The July WTI crude oil contract down 651 basis points, trading at 74.07. A breakdown in oil now a stone throw away from its 52-week low. We'll take a look at that chart in the postgame, and Eric will have the EIA inventory data. The July RBOB gasoline down 447 basis points to 235. The August gold contract up 145 basis points, trading at 23.75, trading at the top of a one-week trade range. Copper down 397 basis points, trading at 460, now deeply reverting the April and May rally. Uranium down 216 basis points, trading at 88.35. The U.S. 10-year Treasury yield down 31 basis points, trading at 4.30. Sharply turned down, now yields below the May lows. The key news to watch this week is Friday's jobs numbers, and next week we have the CPI and PPI inflation numbers, the FOMC and Bank of Japan monetary policy statements, and the University of Michigan consumer sentiment. This week's featured interview guest is ECRI co-founder Lakshman Achuthan. ECRI provides actionable information about economic cycle turning points. Eric's interview with Lak is coming up as MacroVoices continues, right here at MacroVoices.com.
And now, with this week's special guest, here's your host, Eric Townsend.
Joining me now is ECRI co-founder Lakshman Achuthan. Lak prepared a slide deck to accompany this week's interview. Registered users will find the download link in your Research Roundup email. If you don't have a Research Roundup email, just go to our homepage, MacroVoices.com, look for the red button above Lak's picture that says looking for the downloads. Lak, it's great to have you back on the show. It's been, I think, more than 6 months now. We have, for any new listeners, you are Mr. Cycles, business cycles, and so forth. Let's start with an update on the business cycle as it stood when we last had you on in November. I think it was shortly after that you added a new call, which is described on page 4 of the slide deck. So what was the outlook back in November? How did it change with this global growth outlook that you have modified? And what's the outlook from here?
Thank you, Eric, for that intro. And thanks for having me back. November, this seems like so long ago, November of last year. We were talking about a tug of war in the United States between some cyclical impulses to the downside and the forward-looking data, and some non-cyclical offsets, really a lot of excess spending and whatnot, pushing it to the upside of fiscal spending. And how that tug of war was ongoing. It was keeping us, the United States, out of recession, and it remained to be seen how it would be resolved. So later at the end of 2023 in December, we made a different turning point call, but I think it impacts kind of everyone, including the United States. And we made what we call a global industrial growth upturn call. So specifically, our leading indicators were anticipating that industrial production growth, IP growth around the world for all the major economies, including all the major emerging markets, that would bottom and turn up. The growth rate would turn up in 2024. And so with that backdrop, there's a little less wind in your face for different individual economies. And it really has kind of dual implications for people thinking about the macro world today. It certainly signifies a recovery in industrial activities. So from the demand side, there's rising demand in industrial activity related things. And so that'll fall over or flow into global trade itself. And that's a positive. The fly in the ointment, in a way, is that it also contributes to rising international inflation pressures due to that increased goods demand. And so that's kind of what we call the sting in the tail here.
Locke, the chart shows a number of series here. One's called Giggly, one's called Gigsly, and one's called IPTY. What do those stand for?
To be fair, it's just a bunch of business cycle people making funny sounding acronyms, but I can decode them for you. The target is the Industrial Production Diffusion Index on the bottom. And in this chart at the end of last year is going down, and I think a lot of people were extrapolating that it would continue to be weak. The forward-looking data are the green lines. The top line is the Global Industrial Growth Long Leading Index, and the middle line is the Global Industrial Growth Short Leading Index. They work sequentially. We like to see the long leader make a turn, and then to see it confirmed by the short leader. And you can see at the end of last year, we were starting to get that pattern in our leading indicators. They continued to develop that pattern. So we're pretty confident about the global industrial upturn call that we've made. And you're starting to, I think, see, there's obviously give and take in these more coincident data, but you're starting to see that show up. PMI, I know very recently was a little weaker, but they're basically up in the first half of this year. S&P Global has been ticking up. ISM is down a little bit, but in both cases, you're seeing things like the price indexes coming in quite a bit hotter, even approaching, I think, 60 in some of the readings. So there's something going on globally with the industrial cycle. I think it's starting to pass through to some of the more coincident data. And it's not simply a supply story. It's we're seeing stuff on the cyclical demand side that is constructive.
Okay, so the big picture topic at hand here is global industrial growth. Seems to me like China is a really, really big part of that story. And oh, by the way, a lot of people, myself included, have been a little bit confused about exactly what China's recovery from COVID really looks like or is going to look like, because it hasn't unfolded the way a lot of people expected it to. So I see you've got a slide coming up on page 5 here saying China chimes in. Tell us how China fits into this story.
On a cyclical basis, right? If we go in the way back machine here in early 2023, pretty much everyone jumped the gun and was looking for China to power the global economy and the global kind of industrial growth. And these leading indicators were like, no, not yet. You're premature here. But by the end of 2023, and you see that on this chart here, these leading indicators were becoming much more constructive. And in particular, it was the industrial sector or the export sector of the Chinese economy. It's roughly 20% of the economy that was starting to finally get some actual traction on a cyclical basis, meaning it's going to be more pronounced, reasonably pervasive, and persistent. And that's what's unfolding here. So it's part of the global industrial growth upturn. It's not the only reason for it, but there is a pervasiveness. China, even in the US and in Europe, where we're getting this kind of manufacturing activity where we're all part of the global manufacturing floor. We're all kind of gearing there a bit together.
Okay, so an upturn in global industrial production definitely sounds like a good thing. All good things have potential negative consequences. The risk associated with that one is it could cause inflation. Wait a minute, we already got an inflation problem before we started. So where is this going to leave us, Locke, as we get on to page 6 here?
6 it's a really esoteric kind of chart. This is global or international inflation. The target numbers are on the bottom. I think this chart, again, is from the end of last year from a client report, but you get the picture that the coincident data is cycling down. So the consensus view is, hey, everything's going down. We're, easy peasy here. We're going to be getting to rate cuts soon. I think if you remember back to the beginning of the year, there were many, many rate cuts priced in, depending on which economy or central bank it was. And that all sounds pretty good, right? But the problem here is that we may not get back down to those very low inflation readings before we see the next inflation cycle upturn. And our forward-looking data really has started to signal, hey, we're moving. We think the inflection point is here in 2024. The inflection point on the bottom, the trough in inflation, isn't way off on the horizon. It's somewhere this year. And when you look at the narratives around inflation, certainly there's a lot of reading the tea leaves and saying that this measure is wrong and that component is wrong and we've estimated this and that wrong. And I'm sure all of that is true. But the overall cyclical dynamic of inflation cycles, which not a lot of people actually look at, they tend to say inflation follows growth. That overall dynamic is actually to the upside. And when we try to hear the story that the leading indicators are offering up, right, rather than having a preconception as to what the story should be, when we try to listen to what they're saying, it seems like part of the story, at least, is that goods inflation, the goods sector inflation, if we oversimplify, let's call it services and goods, right? So the services are higher inflation and all that, but let's put that aside for a second. The goods inflation, which has been helping coincident inflation measures go down for the last few quarters, that may have run its course and it's going up. And that's not baked into anyone's narrative about inflation being under control. So I think part of the story here in 2024, if inflation remains sticky or moves to the upside internationally, is going to really come out of less goods disinflation and more goods inflation than people were bargaining for.
Now, there are some inflations, Locke, where the economy heats up and the additional money that's available has some positive effects as well as negative effects. There are other inflations like the 1970s where you start to get a runaway situation where it's, the central bank is trying to fight it by increasing interest rates, but the damage that they do, the collateral damage that's caused by increasing interest rates to fight that inflation does almost more damage than the inflation itself does. Is there a way from your cycles work to either anticipate or to determine after the fact on a backward-looking basis, okay, we've crossed that threshold. We're out of a regular just economy heating up kind of inflation. We're into a runaway inflation. Is there a way to know when you've hit that point or when you're going to hit that point?
I mean, it's hard to really know, but I think my closest answer from our work and our indicators would be the future inflation gauges. So on page 6 on the international slide, we have the 11 country future inflation gauges in the middle. And I can tell you that line has continued to edge up. It's not running away sharply like the top line, which is very much a directional indicator, the ILFIG, International Long Leading Future Inflation Gauge. That is a directional indicator on page 6, the top one. The middle one has been done a more gentle upturn, but it's no less important because it is giving us a directional call to look for a trough in inflation as opposed to it continuing to decline. Now, the problem is, and maybe this segues a little bit into the United States, which is, I have a related inflation picture on page 7. The problem is that the target, the expectation, the hope, whatever you want to call it, is that inflation is going to go down to around 2% and kind of hang out there. And that doesn't seem obvious from the forward-looking data that we're looking at. The future inflation gauge, which really nailed the inflation cycle upturn that the Fed was late to, and that it has been kind of paying the price for ever since. And then it also nailed the inflation cycle downturn, which the Fed is hoping will just continue. Except the future inflation gauge stopped falling several quarters ago and has been going sideways. And that led us to talk about sticky inflation and so on and so forth. And now that's fully priced in, right? Everybody's priced in for sticky inflation. So where do we go from here? If the future inflation gauge breaks to the upside, now we've got a trough in the inflation cycle, which is higher than hoped for. It's occurring at a higher pace of inflation than hoped for. And that's historically not been great. It means you're starting to get some floor under inflation. And many listeners, have probably gotten used to over the last decade or two of inflation always being low, right? So this is a new game to have a floor under there. And from a central banker's point of view, a lot of their credibility is around this inflation fighting stuff. So that is what may lead them to, as you said earlier, kind of tighten so much that, or be restrictive so much so that there's a harder landing. We don't see that at the moment, right? We don't see a hard landing here on the growth side, but this inflation component part of it could be something that upsets the apple cart. We don't know. And the future inflation gauge, let me just describe it, that it's going, it continues to go sideways. It's been in a bit of a band, and it's kind of at the upper end of its band. Here on this chart, I'm sharing something slightly different. It's not inflation itself. Here we have a U.S. leading index of inflation expectations, specifically 10-year break-evens. And this could be interesting, for different kind of rates analysis, but it's also interesting because I do think a couple of Fed heads or whatever have started to talk about this. Let me see where these 10-year break-even inflation expectations are going. And this chart is a bit more recent, right? This is from last month, and you see the directional move, if you can, by just eyeballing, it's to the upside. So it doesn't suggest any near-term relief in those inflation expectations. So again, it's kind of a roundabout way of giving a clue to the question you were asking about when does it become a problem.
Locke, let me push it even a little farther and ask you about a bigger picture question, which I guess is a cycle question when you think about it. And that is this. I think that we face a generational risk factor, which is that there's literally no professional alive who knows how to trade or has any real experience trading secular inflation. All of the guys who are expert at that got their expertise working in the industry in senior positions in the 1970s. they're all in their 90s now, mid to late 90s. So they're not going to come to the rescue and be the guys who are the voice of experience who say, look, I know what to do here. I think we have a problem where the entire industry is going to just crash straight ahead into, wait a minute, even the professionals aren't sure what to do when you get a structural inflation that starts to run away to the point the central bank doesn't know how to cope with it. Now, whether or not we're really in that situation or if that situation is coming up is something I ponder a lot. Do the cycles tell us that? And more importantly, what do the cycles tell us about what happens when the industry has to face something that requires a skill set that hasn't been needed in such a long time that there's nobody who's ever done it before working?
I'm remembering a conversation with a client a little over a year ago, and it was a little bit along these lines. And it's a medium-sized hedge fund, which is, a good hunk of money. And he was saying, I think they had like 75 something people working there. And he's like, it's me and one other guy who remember that stuff. And everybody else has been trading in this other world of lowflation and QE and extraordinary monetary policy, all these other things. And so they don't know what that's like. And he was kind of lamenting that. But these indicators, I think, give us some bearing. I'm not saying they're, the Holy Grail, but I think they give us some bearing. And the reason I say that is because the indicators on a directional basis, indicators of inflation and growth in this case, I'm saying on a directional basis, they've withstood some massive structural change over more than a century of cycle experience in the United States and well over half a century of cycle experience internationally. So we definitely are in a strange, seemingly new world, right? And it's hard sometimes to get your bearings when, the level of debt is in the tens of trillions, and that could ramp up very quickly, and there can be extraordinary policy approaches and all kinds of things. But the inflation cycle and the business cycle or the economic cycle, as long as we are in an environment that is dominated by free market oriented activity, those drivers of directional turns are alive and well. I think sometimes we wait and see, are the bond market vigilantes coming back or not? Or, are they still asleep? Are they back? Where are they? Time will tell. But for example, this one indicator here on page 7 is telling us, inflation expectations, 10-year break-evens, they're not going to fall. Okay. And how do you deal with that? That's a different world. You have to pay interest to hold inventories. You've got to pay interest to refinance your real estate holdings, right? These are new ideas, right? And it could, in theory, squeeze your margins unless you're NVIDIA, right? Everybody else, it's going to squeeze their margins. So that is an interesting world to inhabit, and it's good to have some way of navigating. And so our proposition here is that we may not know exactly what's going to happen, but we think we're looking the right way.
Locke, you've got a title on page 7 which says U.S. inflation expectations are likely to rise. I happen to agree strongly. I think they're going to rise a lot, but I want to understand what you think. When you say they're likely to rise, first of all, why are they likely to rise? Is it just the data telling you that, or is that a subjective opinion as well? And how much are they likely to rise? Are we talking a little bit or a lot?
I can have a subjective opinion that there's a whole bunch of things that have happened, like lots of money sloshing around, or some structural shifts or geopolitical things that are really putting a big secular floor under inflation. But those are subjective, right? And that's okay. There's nothing wrong with that. I have a little bit of experience, so maybe that's a worthwhile view. What you're looking at on the chart is something different. You're looking at much more objective, forward-looking leading indicators of inflation expectations. That's the top line. And the reason for being of that line is that it should turn ahead of cyclical turning points in 10-year break-evens. And when we try to objectively assess whether the leading indicator, not subjectively, but objectively assess, has that leading indicator turned, we ask, well, okay, how pronounced is the upturn in the leading indicator? How pervasive is it in terms of the components going into it? And how persistent is it? And when we ask those, what we call 3 Ps, pronounced, pervasive, and persistent, how much of that is presenting itself compared to past cyclical upturns in the leading indicator? And if the answer is, hey, I can check the box. Yeah, it is persistent. Yeah, now it's pronounced. And when I look inside of it, that's proprietary. But when I look inside of it, yeah, it's pervasive. The majority of the inputs are pushing it to the upside. Now, the leading indicator has objectively said directionally it expects, or we should expect, the target to move in concert. And so, and that's really, let me just put a period there. That's all it says. It actually doesn't have a great deal of information about the magnitude of the move in 10-year break-evens. Directionally up on a cyclical basis, so that means it'll be the target, in this case 10-year break-evens, should have a pronounced, pervasive, and persistent cyclical rise. That is the expectation. But how pronounced, I can't dial it in that clearly there. I'm afraid that's not the strength of the indicator.
Locke, let's talk about precious metals and gold in particular. It seems to me like something's changed. First of all, the mining shares have absolutely not responded as the price of the metal has moved higher. But furthermore, as we look at the gold market itself, we see that the correlation to the dollar index, which used to be strongly inverse, isn't really there the way it used to be. And it seems like everything's just trading to a different drummer. What's going on here? Is there something that the cycles data can tell us about why gold seems to be on a different agenda than it's been on in the past?
That's a great question. We don't have an indicator that kind of targets gold or a specific price like that. But having said that, a couple of things come to mind. One is, going back to the beginning of our discussion, the global industrial growth upturn call is a bullish call for commodity price inflation. And while gold is certainly special and precious and not necessarily an industrial kind of thing, it is, related, and it works as a little bit of a hedge there as that whole sector moves up. That doesn't hurt it. I think you've got, with the global industrial upturn call, it helps emerging markets, and they're certainly interested in gold as something to buy as they're more prosperous. But I think also you've got a kind of a layering, each of these cycles, these extraordinary policy reaction functions, right? Where it's always whatever it takes. It seems to be the reaction out of central banks in particular when the economy weakens. And so there's certainly soft landing versus hard landing kind of concerns out there. There were some recessions in other parts of the world. And each time you go from, I think it was like post GFC, our debt, went up a lot, maybe almost to double digit trillions. And then post COVID, I think we're sitting at, I don't know, I'm losing count, but is it like 34 or something trillion? It's pretty big, right? And so you have to wonder, just how much of that you want to be a part of. And gold is a hedge on that, I think, more holistically. Those are my thoughts. Cyclically, I think global industrial growth or inflation hedge probably support gold to a degree.
You mentioned the central bank reaction function, so let's talk about that next. It seems to me like one of the themes that's going on right now is that central banks around the world are under increasing political pressure. The Fed claims to be completely independent, but boy, there's been some pressure for them to cut, even though it seems like inflation indications would suggest, if anything, a hike is what ought to be on the table. Meanwhile, the ECB is widely expected to cut, and I think that's a function of political pressure. Why would your call, as I've understood it from this interview, very much echoes what Jim Bianco has told us, which is inflation is probably already bottomed. The bottom is in behind us. So, why would you be cutting in that environment? Because politicians threatened that if you didn't, you're not going to be Fed chairman anymore. That's the only reason I can think of. Do the cycles tell us anything? I don't know if you have like an inflation year politics cycle that tells us when to expect silly season to have crazy effects on statistics that are otherwise reliable.
Well, it's interesting, right? I mean, one way to get elected is to give people stuff, right? It's not that complicated. So people do that. And I think it actually happens on both, all over the political spectrum. That kind of basic logic is at play, which isn't great if your job is to kind of have low and stable inflation and, decent growth to support jobs, which is in the United States, the mandate. And so I think you're 100% correct that all these central banks are run by human beings on I think, for the most part. And so whether they have the wrong models or not is another debate, but they're certainly subject to how people feel about them. I think it's very hard for them to go against the grain. You mentioned earlier that a lot of people haven't had experience with secular inflation. And, hopefully people have read about the 1970s. And you had Arthur Burns in the beginning, parts of the decade, which was an inflationary kind of secular inflation. And you had Paul Volcker toward the end and into the early 80s. And that was an interesting decade, and I can kind of paint a mental picture here. From the late 60s into the early 80s, inflation averaged 7%, just about. It's like 6.9. And I think the low in the inflation cycle might have been just below 3%, and the high was approaching 13%. So huge swings in the cycle. And there were, I think, three big ones, three big troughs, and then three big peaks in inflation over that decade. And there were a bunch of recessions in there. And the pattern that comes out in that secular inflation with, say, three inflation cycles in it is that you had higher lows in the inflation cycle. And so if we go earlier in our discussion here, I'm kind of warning about that, saying, hey, everybody thinks we're going to 2% and going to hang out and stay there. And there's a reasonable narrative here that we don't make it there and we trough before that and then cycle to the upside. We have to watch the future inflation gauge. So that's where inflation starts to get embedded in, and it got embedded in the 70s. And it's interesting, the popular kind of mood in the first half, roughly, of that decade, inflation wasn't something people were like continually screaming about. They were upset here and there, but there was some jobs growth, and you're like, all right, it's kind of there's this kind of money illusion where nominal things were going up, and you weren't so focused on what was happening on a real basis, an inflation adjusted basis. But toward the end of the decade, when inflation was really up there in those double digit numbers, that gave the cover in a way for Volcker to be, kind of the adult in the room and really clamp down on inflation. And even then he gave in. Okay. And he had a lot of intestinal fortitude, let's say, right? But he still gave in and had to raise rates again, which contributed to the 1981-82 recession, which was a very long recession. It was over a year and a half. And that finally broke the back of inflation. I don't think people really appreciate all that. Some people may, but on the day-to-day kind of discussions that you might hear in the various narratives, I don't think that that's really fully understood.
Locke, let's tie this all together now as we go forward. Which indicators should we be paying attention to? What information should we be looking to derive from them? Keep our eye on what?
As bifurcated as the economy is, some call it a K-shaped kind of economy where, the upper part is doing well and lower income is really getting squeezed by the inflation we've been talking about. It all adds up to continued growth. That is our expectation for the next couple of quarters. And on the inflation side, that's the one I can't take my eye off of that because of what we talked about with the international inflation bottoming and likely moving up to the upside. Odds are that the U.S. does that too. They tend to move in sync. But to really make that call, we have to watch if the future inflation gauge breaks out of this range that it's been in and starts moving to the upside. I can't predict the predictors as much as I want to. I can't. And so I try to stick to my knitting. I'm watching it closely. I think that the other kind of thing to watch as you hopefully get a little bit of a break this summer is the story around goods inflation, because I think the everything is happy and don't worry about it crowd really presumes that goods disinflation is going to continue to be a component of everything being okay. And with the global industrial upturn call that we've made and we feel pretty good about, there's a demand on the demand side of global industrial activity. And so trade and different types of early inputs and goods themselves are going to be moving to the upside. This is even showing up in China, by the way, where the kind of deflation fear is really not on our radar screen. It's not what's happening there. So steady as she goes, try to take a break this summer, but keep an eye on that forward-looking inflation data, which I'll be reporting on.
Well, Locke, I can't thank you enough for a terrific interview, but before I let you go, please tell our listeners a little bit more about what you do at ECRI, what services are on offer there, and how our institutional listeners can find out more about your services.
We work with asset allocators, different types of fund managers, certainly on rates, as we've been talking, and on other risk-on assets, and also some C-suites, global C-suites. And it's all about direction. The main thing that we add to the decision-making process, be it in asset management or otherwise, is, am I looking the right way? How do you not get hit by a bus? That's what we're really adding in. And we try to, we work with clients to kind of fit that information into their process. And it's a lot of fun, I must say. I enjoy it.
Patrick Ceresna, Nick Galarnik, and I will be back as MacroVoices continues right here at MacroVoices.com.
Now, back to your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Lack back on the show. Now joining us again in the post-game segment is Nick Galarnik. Now let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Lack's picture saying, looking for the downloads. Now, Eric, let's cover crude oil starting with the EIA inventory.
EIA printed builds across the board, with crude oil posting a 1.2 million barrel build, Cushing, Oklahoma building 854,000 barrels, but the really big builds were on the finished products, with gasoline building 2.1 million barrels and distillates building 3.2 million barrels for a net petroleum build of 6.5 million barrels. U.S. production held unchanged at 13.1 million barrels. The decision by OPEC Plus not to extend cuts beyond the end of calendar year 2024 is being perceived as a strategy change on the part of OPEC Plus to focus on protecting market share rather than protecting price. I think it's a little bit premature to really read that much meaning into it. We don't know. All we know for sure is they didn't decide at this meeting to extend any cuts beyond the end of 2024. We don't really know that there is a change in strategy, so I think it's premature to interpret that way, but that's the way the market has been seeing it. So it's no great surprise that brought us back down to the low 70s on WTI, and frankly, I've been focused on other markets and not paying a whole lot of attention to crude oil. I don't think there's really an exciting trade in crude oil right now because there's just too much risk of geopolitical upsets that could throw the market in one direction or the other, being unpredictable. And there's plenty of good opportunities in gold and uranium.
It was quite the breakdown in oil, Eric. And the interesting part is that we're now a stone throw away from the 2023 and 24 lows, which were as low as around the $68 range. We're still a few dollars away from anything like that, but certainly technically you can see that we're approaching a key support line. The thing with the breakdown that happened this week was that it really set in motion the continuation of a downtrend below the 50-day, which usually results in a prolonged consolidation. And while assuming that support holds, we could end up spending the rest of June and early July establishing the bottoms before there is an attempt to bull run on the upside. At any point, there could be a reaction of a couple dollars, but at this stage, I'm considering oil to be range bound and that the next bull setup will be a little bit later in the summer. Let's get to the equity markets and get Nick involved in conversation. Nick, let's start with that S&P 500. What are the levels you're watching?
Yeah, Patrick. So right now the spot price on SPX is approximately $53.50. We have an implied move for the June 21st monthly OPEX a couple of weeks away of plus minus 100 points. Therefore, the upper implied move is $54.50 and the lower implied move is $52.50. Right now, we have no key resistance because we're at all-time highs, and key support is at $52.50. I'm inclined to think we see a push toward that 5,400 plus area with a topping point around 5,500 in the short term.
Nick, I agree with your upside targets. The 5,400 is obviously the first upside hurdle, and 5,500 to 5,600 are upside measured moves. But I think all of this is going to rely on how NVIDIA trades moving forward. There's a couple of major catalysts, and I suspect that the swing high of the S&P 500 will line up with ultimately where NVIDIA has some sort of a short-term topping formation. Now, right now, there is nothing but pure momentum in NVIDIA on the upside, but there's the catalyst with the stock split position to occur on Monday and a potential big fund rebalancing in the XLK occurring on the 14th of June. It is very likely that next week will play an important role in determining where NVIDIA's upper boundary is going to be. Now, right now, with this kind of momentum, there's nothing stopping it from still tacking on $100 or even $200 on the upside. But ultimately, when that top comes in on NVIDIA, that will likely line up with where the S&P 500 makes the turn. And so to me, watching how this plays out next week is going to be key. Now, let's move on to the Nasdaq. What are the levels you're watching on the Qs?
Right now, spot price on the Qs is approximately $464, and we have an implied move for the June 21st monthly OPEX of plus minus 12 points. Therefore, we have an upper implied move of $476 and a lower implied move of $452. Right now, we have no key resistance as we are at all-time highs, and key support is just below at $460. As you mentioned with NVIDIA, I do agree with you. I think that the market goes with NVIDIA. If it keeps on pushing, the market will push higher. And likewise, if the NVIDIA starts falling, the market should fall as well. One thing very interesting to note, well, a couple of things anyway. You mentioned XLK rebalancing next week. That's very interesting because if NVIDIA's market cap exceeds that of Apple's on the rebalancing date, what happens is that we see a flip from a current allocation of Apple at 22% and NVIDIA at 5%. To the reverse of that. So not that it really matters so much for XLK, it's not a huge ETF, but what will happen is that the implied volatility of the ETF should increase significantly overall. Otherwise, one thing I want to mention too is that yesterday alone, NVIDIA gained 5%, which added about 150 billion to the market cap. That exceeded the entire valuation of Intel plus 20 billion in a single day. Pretty wild.
All right, Nick, let's just move on to the volatility index. The VIX is back down to the 12 handle. We saw obviously a little bit of a spike during that correction, but we're right back down to the lower boundary. What are the levels you're watching?
So right now with the VIX at nearly 13, we can expect to see intraday top to bottom moves of about 0.75% roughly. As we push those new highs, it's kind of interesting because the VIX is not making new lows. However, if we do push that 5,400, 5,500 level on SPX, I do expect to see a breach below 12 on the VIX. So looking out toward the election, if you're buying insurance, it's pretty cheap right now overall. Not a bad idea to look at some hedges, as I do think we see perhaps a swing high to 5,500 or so on SPX, followed by a decline into the election overall.
So moving on to the U.S. dollar, we continue to see range-bound price action. No sign that the dollar is yet breaking out, but we just had rate cuts from both the Bank of Canada and the ECB, and we are now have the FOMC coming up next Wednesday. And it'll be really interesting to see whether the dollar starts to move after all of these central banks have released their monetary policy statements.
And moving on to page 8, we had that gold futures chart. What are your thoughts here?
Well, just as I predicted last week, gold needed to dip down to test that 50-day moving average before it could correct higher. That's exactly what happened. Now, it's still early to say, but it looks to me like the bottom is probably in for this correction, and Wednesday's action certainly seemed to suggest that we're going to trade nicely higher from here. If we can keep that momentum going and keep this rally going, I think we probably are headed on this leg toward another all-time high.
While gold has certainly stayed above its 50-day moving average and now has worked its way towards 2,400, this is actually a very important line in the sand. If this rally in any way fails below 2,400, there could still be one more leg lower down to 2,250 on golds. It really is important for the bulls to follow through on this north of 2,400 in order to resume the bull trend. So it's a very important moment right here at this exact price level. I wanted to move on to the copper chart. We were talking over the last 2 weeks about a correction in copper after that very steep rise. But now that we've fully tested the 50-day moving average and have approached Fibonacci retracement zones, this is a really interesting level to start seeing whether the buy on dip traders show up. This is a tactical place where the copper bulls will certainly give it a go. And so let's see whether or not the support starts to come in here. We could see a temporary drop as low as 440 on the short term, but generally this level should hold if the bulls are going to keep command of this trend.
And moving on to page 10, we have that uranium chart. Eric, what are your thoughts here?
Well, I think what's happened with uranium in the last few weeks is that many speculators, myself included, got a little bit ahead of ourselves thinking that the rally that we've been predicting was upon us or was starting a couple of weeks ago. In reality, there was a little bit of a move in some of the uranium mining shares, but the spot price of uranium is essentially unchanged. And I think what's happened is the market can't move higher until the underlying spot price of uranium moves higher. Maybe there's a buyer's strike going on or something. The buyers just had their annual convention this week. Let's continue to stay tuned to this market because there are incredibly strong demand characteristics, and the imbalance of supply and demand just couldn't be stronger. So I'm convinced the next major leg for this market will be up. It's a question of time, and I don't think the stocks move until the underlying price of the commodity moves first.
Well, when looking at that Sprott Physical Uranium Trust chart, it obviously had a pretty steep decline in the last week. The interesting part is that really has not been driven by spot prices of uranium declining, but rather the closed-end fund trading at a discount to that net asset value, which I show in this overlaying chart. And what we now have is that the Sprott Physical Uranium Trust is trading at about a 10% discount. We've seen a period where the discount was as much as 15% briefly, but we're now approaching levels that typically the divergence will reconverge. It'll be interesting to see whether this presents at least a tactical short-term opportunity to fade that discount. The last thing I wanted to just touch on was the 10-year Treasury note, the chart on page 11. And what we have is a distinct breakout of the descending trend line that you could draw by just connecting all the highs that were put in this year. As well, the last correction that we had the other week did not follow through to make a lower low, and we're now consolidating at the 50-day moving average. Now, I don't want to get outright bullish 10-year Treasury bonds just yet, but the one thing to watch is going into next week where we have the inflation numbers and the FOMC. If the 10-year note can keep above the 109 level during consolidations and build on this, we may have a turn point here in the bond market. And it's certainly one of the things I'm watching closely here.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. Patrick, tell them what they can expect to find in this week's Research Roundup.
Well, in this week's Research Roundup, you're going to find the transcript for today's interview, as well as the slide deck that LAC provided and the chart book we just discussed here in the postgame, including a link to a number of articles that we found really interesting. So you're going to find this and so much more in this week's Research Roundup.
Well, that does it for this week's episode. We appreciate all the feedback and support we get from our listeners and are always looking for suggestions on how we can make this program even better. For those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account @MacroVoices for all the most recent updates and releases. You can also follow Eric on Twitter @EricSTownsend. That is Eric spelled with a K. And follow Patrick @PatrickSeresna. On behalf of Eric Townsend, Patrick Seresna, and myself, thanks for listening, and see you all next week.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Macro Voices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to Macro Voices on iTunes to have Macro Voices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. Macro Voices is presented for informational and entertainment purposes only. The information presented on Macro Voices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Macro Voices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.